Hey, all you house stackers, it's Jim Garvin with stackinghouses.com. Really excited to talk to you today, and I'm joined by my partner in crime, Damon Santamaria. Damon, how you doing today?
Jim, doing great. I'm really excited about the conversation today. As you know, we're going to be talking about insurance, which is such a critical part of the equation for real estate investing. You need to get this correct right out of the gate, or else it can come back to haunt you. So listeners, if you're multitasking, come back to us now and listen up. This is something that you don't want to miss.
That's so true. I mean, when you're thinking about those fundamentals, those big costs that go in, but also not only what you're spending, what you're protecting your assets, this baby that you're building. This is such a key session. And so I've been excited too, Damon, and I think it's a great time to intro our guest today. Guest, we have an amazing person on the line with us today. His name is Sam Fink. Sam Fink is a wonderful insurance agent who actually insurance broker specializes in real estate investors. And so he has a portfolio over $15 million of real estate investors that he supports. So $15 million of assets for which he underwrites the insurance, brokers the insurance for those real estate investors. Sam works for Advantage Insurance Group out of Glen Carbon, Illinois. And besides being amazing in what he does, he's a tremendous man and family man. Sam, welcome to our show.
Yeah, thank you guys for having me. Something I'm super passionate about, so I'm really excited about this time together.
Sam, give our listeners a little bit more feel for kind of where you come from, a little bit about yourself, and how did you get involved in this crazy thing called insurance?
It's definitely not what little boys dream of doing when they grow up. I think that's for sure. But in my past life, I was a professional soccer player. Joined the insurance group through a family friend. Brought me in and just kind of got my feet wet. My wife and my mother-in-law own and operate a real estate brokerage here in Glen Carbon. So real estate's something I've always been exposed to, something I've always been interested in. And so naturally, as I got my feet wet in the insurance world, that was kind of the niche that I wanted to explore and become an expert in. And
for our listeners, if you're trying to find your map of Illinois, Glen Carbon is really an outside of the St. Louis, the greater St. Louis area. There's part of St. Louis, Missouri. That's where I'm from too. That kind of bleeds over into the Illinois side. So Sam's probably a 30-minute drive for me. And Sam, you actually provide insurance in how many states now?
Personally, I am in 23 states and looking to expand that every day.
Awesome. Well, let's dig into this. So we want to do a couple things today. Listeners, we want to provide some fundamentals of what types of insurances, just a broad strokes, what should you be considering and knowledgeable about, all the different slices, and Sam's going to walk us through that. And then we're going to move back into some practical pieces. And I think Damon, if I remember right, he's got some good zingers for Sam. I know he'll be ready for it. Just around some of the nuances that happen as you start, buying these properties and wrestling through the real life things that happen. Remember, that's what we're trying to do here, house stackers, is give you the ammo, give you the practical knowledge to be able to execute on managing these properties or working with your property manager to manage them. So Sam, can we just start with, would you describe for our listeners, what are those kind of major components of insurance to be considered when you're investing in houses and rental properties?
Yeah, of course. Thanks for bringing me in on that. So I think, as you start to consider what property makes sense, what property does not make sense, I think that the basis of the insurance program is going to be your replacement costs. So that is, what is it going to cost me to replace this home and get this thing rebuilt if there was a total or even just a partial loss? So I think that's kind of step number one. There'll be two options for you. You can have what's called an actual cash value policy or what's called a replacement cost policy. I would always recommend the replacement cost. The difference in those, and I don't want to nerd out too hard here, so interrupt me if I am, but the difference in those is just how they're going to settle the loss. So let's just say you have a $30,000 kitchen fire that occurs. On a replacement cost policy, what they're going to do is they're going to come in, assess the damage, and then replace that just as it was. So you're going to get that full $30,000 minus your deductible to rebuild and repair. On an actual cash value policy, what they're going to do, they're going to come and assess the kitchen. How old is it? The wear and tear of everything that was damaged. They're going to take that $30,000 number. They're going to subtract for depreciation on all of those appliances, all of those things that were damaged. Give you that amount minus your deductible.
Got it. So you're kind of talking about how does a claim get valuated? And what I think about that, and maybe Damon, if we can pull you in here, is, also remember, listeners and house stackers, that you've probably got a note outstanding to a bank. So if there's a complete, issue, where the place burns to the ground, you've got to now take care of this note that you owe the bank and deal with whatever you're going to do with that property, whether it's liquidating as is, it's just a lot, trying to rebuild on it, etc. So having the amount of insurance to cover that and make sure that you can both pay the bank back, get back your down payment or whatever you've invested into it, and be able to be at a good, good logical place to make decisions is extremely important. Sam, would you agree with that?
Yeah, I absolutely would. And I think another little nuance I want to just mention in that is, if the first time you get the replacement cost estimated, you're going to see your policy, you got your quote. You're going to say, okay, I paid $100,000 for this property, this first one I'm owning. Probably replacement cost is going to be similar. Well, what you paid for it, market value of the house, really has nothing to do with the replacement cost. The replacement cost is going to be cost of materials, cost of labor, cost of debris removal if it were to totally burn down, and kind of the total amount there. So it's always going to be higher than market value. So I would just prepare yourself for that number, because I'm sure that it's going to be like, wow, I think that I could do it cheaper than that probably.
And guys, you mentioned the deductible, which, historically I've always taken the approach that, you would maybe opt for a higher deductible, because if you're going to have a claim, it's going to be for a pretty catastrophic event. It's not going to be for, a $2,000 or $3,000 mishap that happens. And the logic is that, as real estate investors, we're interested in cash flow, monthly cash flow. And if you have a higher deductible, I think it reasons to stand that, you'll have a lower monthly payment. So Sam, maybe I'm thinking about this correct, maybe not. How should investors think of the deductible in relationship to their monthly payments?
Yeah, I think that you're right on track. The difference between, let's say, $1,000 deductible and a $5,000 deductible on a home can be hundreds of dollars in premium. So that's a way to instantly save. I would say as the portfolio grows, that's when I see the deductibles grow as well. Because like you said, you're not going to be making these small little claims here and there. When I see the $1,000 or $2,500 deductible is usually when people are just beginning and saying, okay, if there is a loss, maybe I don't have the cash flow or the money to fish out $5,000 before I can get it repaired. So I'm going to stay at the lower number. But as you grow, I think it definitely makes sense to up that deductible.
Awesome.
Perfect. Thank you.
So Sam, I think that was a really helpful intro. Now kind of moving into what types of insurances our listeners and our students should be thinking about. So the difference between property, GL, umbrella, all these concepts that we hear on commercials that speak way too fast. Can you kind of break that down for us and bucketize what those are, and maybe just a general opinion from your perspective on what home investors should be thinking about as they start on this journey?
Yeah. So like you said, there's different buckets. So coverage for the property itself is going to be on every policy. So that's just the normal, catastrophic acts of God that would happen to the property. It's going to be repaired. That's on everything. Next is the liability portion. And this is actually something that I am extremely passionate about, because I think, unfortunately, in the day and age that we live in, liability claims are becoming your greatest risk, if you will. So what I would say is there's a difference if you've got a giant portfolio under an LLC. that's going to be a different conversation than if you're writing this under, a personal lines or just 1 to 10 portfolio, I would say. But on that smaller portfolio, what I would say is the difference between $100,000 of liability coverage and $500,000 of liability coverage on that policy, premium wise, it's going to be $5 to $10 for the year. So when you get a quote, make sure that at a minimum it's at 500,000, because again, it's an extra 400,000, maybe sometimes more of coverage, liability claims for not much premium. And what the liability would be is if someone came on your property, they slip, they fall, they hurt themselves, they bring a lawsuit against you, that liability coverage, that $500,000 is going to cover you for not only if you have to go to court for it and pay them for their bodily injury, but it's also going to cover you for the defense costs during that process. So super important. And then along those same lines, they offer what's called umbrella coverage. So an umbrella is just simply an extra layer of liability coverage over your whole portfolio. And this is going to extend actually onto your personal items as well, your house and your car. It goes in increments of $1 million. And I would say premium wise annually, I see $150 to $300 for the year for an extra $1 million of liability coverage. So again, you can see it's the cheapest form of liability coverage out there. If you don't have it already, I would say that this is step number one. Go and get that.
Sam, this is literal gold for our listeners. Appreciate you kind of going into all of these different pieces here. One of the pieces, that we don't like to think about is some of the fine print and some of those exclusions that sometimes fly under the radar. And a classic story that I have is, early on in my investing career, I bought a rental property in Atlanta, Georgia, and the property was sitting vacant while the property managers were looking to fill the property. There was a freak ice storm. I think the temperature got down to something like 6 degrees. And as I mentioned, the property is sitting vacant and there's no utilities turned on, there's no heat, and no one thought to turn the water off at the property. So as you can guess, there was a pipe that burst, causing thousands of dollars worth of damage. When I contacted my insurance company, of course, they denied the claim for a couple of different reasons. Number one, the utilities were turned off. Number two, the water was left on. And then number three, I think more importantly, was that the property was sitting vacant. And so my policy specifically had an exclusion for that vacant property. So can you explain to our listeners the critical distinction in insurance policies so that we can kind of avoid these situations or maybe even think about them differently in the future?
Yeah, that's a great question. And I think when I think about that story too, it makes sense. You buy your property, you get it insured. You're not thinking, okay, now what happens if this were to occur? What happens if I don't have renters for this month? So it's a great question. The difference, insurance companies see a vacant property as a much greater risk than a property with tenants in it. And reason being is just because nobody's at the property. Nobody's going and checking up on it. Nobody is making sure that the water is turned off. Nobody's making sure that nobody's vandalized, that kind of thing. Usually, and this varies carrier to carrier, so you can't, it's not just a one size fits all here, but usually a carrier will allot you 30 days of vacancy before the policy either needs to be endorsed or just completely rewritten. So after 30 days of no one being in there, if you couldn't find a tenant in time, you couldn't find a renter, then that's when you're going to need to contact your agent. And some companies, so we write with a company called American Modern, they specialize in this kind of thing. They will actually endorse the policy. The endorsement is not very much, it's $50 to $100 for the year. And that endorsement will just say, if anything like what happened to you occurs, it will be covered because you have this endorsed. You told us it was vacant. We know the whole story. The other way, if it's going to be, longer period of time, and maybe let's just say you're going to do a few updates in between tenants, then what we would want to do is cancel that policy right there and just rewrite it as a vacant policy. So that way, again, insurance company is in the know. It's written as a vacant policy. Anything happens, is covered.
Got it. Thank you.
That's great, guys. So I want to go back and touch on a couple other different types. And some of this is experiential for me in my portfolio. Unfortunately, we did have a home that we purchased as a one home of a package of 10, and it was in a flood zone. So, Sam, could you talk a little bit about, earthquake insurance, flood insurance, also some of the exclusions within your general policy? So that could be something like Sam and I are both here in the Midwest. Most of the houses here throughout the Rust Belt have basements, sewer lateral backups, and things like that. So maybe could you just kind of take us on a little bit of description of what some of those are and how you would think about it?
Yeah, absolutely. So like you mentioned, I would say the four most common exclusions I see in the policy is going to be flood, it's going to be earthquake, it's going to be water backup from a drain or sump pump, and then it's going to be vandalism. So those are kind of your four. If you're in a flood zone, and it's a severe flood zone, I would say, when you're getting your lender to give you the money for the property, they're probably going to require flood insurance. But if it's not, then sometimes they don't. So I would just say know kind of what your flood zone is, or at least just talk with your agent and express your concern for that to kind of combat that. Earthquake is excluded on every policy. What I would recommend is we have a carrier that writes only earthquake. So because they write only earthquake, their premiums are generally cheaper than a company that is writing the property, the casualty, the everything. So I would just ask your agent, hey, do you have a carrier that writes earthquake on its own? Because generally that'll save you some money. Water backup is one that is an optional coverage that I would recommend all investors just put in their policy. So it goes in increments of 5,000. So you can assess, what is the cost of the property in the basement if you're in the Midwest, and kind of go from there. That inclusion is usually $60 annually is what I see. So again, not a huge, bank breaker or anything like that, but it gives you that policy if the sump overflows or if a drain overflows. I actually was just reading an article, and they were saying that the average cost of a claim with 1 inch of water damage is $20,000. So you can imagine that, who can afford $20,000 if their basement, and not to mention then the tenant's probably moving out and all the things that come with that. So I think water backup is one that you could include. And the last one is vandalism. If you're screening your tenants and you know who's in there, probably who's going to be coming around, it's in a high traffic area that you're comfortable with, I'm not sure that vandalism is actually worth the cost of including on the policy. But if you are in an area that you would worry about any vandalism or malicious intent or anything like that, that's an inclusion as well that you can add.
Got it. Last one on the types. I know you help out a really good friend of mine, Mr. Michael Fleet, out there in Los Angeles. Michael, hope you're doing well. And I think one of the things you guys have been talked about is actually lost revenue coverage. Would you talk a little bit about that for our listeners?
Yeah, absolutely. So another policy option that you have as an investor is called loss of rents. Basically, what that means is if the home is damaged, any portion of it is damaged, and they render it unlivable, so the tenant has to move out while you repair the home, you're not getting the rent for those months that they are out of the place. So the insurance company with this policy endorsement will actually pay you. Let's just say you do $1,200 a month for rent. They will actually pay you that $1,200 a month until you can get your tenant back in the place. And that number is adjustable. So what I would recommend is just figuring out what rent would give me over the course of a year, and then putting that amount. And they say that average cost of home repair, and now with everything going on, seems like repairs are taking even longer with time it takes to get in materials and everything like that. Average time is a year. So I would just, to be safe, if you want that coverage, I would calculate out what a year of rent is and then put that in the policy. Again, it's not a bank breaker, but it's just something that will really save you if you need it.
Excellent. I really, really appreciate those descriptions. Sam, any advice for our listeners is, they go out and they try to actually find someone to help, find them, policies. What are some great questions to ask in screening for a good insurance agent, making sure you're choosing someone that can be a good partner to your business?
I think the first obvious question to ask them is do you represent any other investors in the area, or what's your portfolio look like? Because real estate investment and the insurance behind it is a very specialized product. There are needs that you guys will have as investors that are unique, and they're not on every single policy. So if that agent hasn't experienced it before, then I think I would steer clear of that and maybe go to somebody that has a little bit more experience. The other thing, and actually what I love about this is, I get to speak with investors that have dreams of what this portfolio is going to do for them in their lives. So maybe it's going to give them an income that allows them to retire and spend more time with their family, or maybe it's just, I've got one and I'm looking to get 10. And I love being a partner in that dream, being a partner in that process, helping you save costs where we can, but also protect you in case of the catastrophic event so that you're not completely wiped out and you have to start from scratch. So what I would do personally is come with a story, come with what your dreams of your portfolio are, and talk with the agent and kind of feel them out that way. If you tell them that story and you feel like they align with that and they're going to help you get to where you want to go, then that's no brainer. Go with them. If they're not, because everybody's busy, maybe they've got too much going on, then find someone else. There's plenty of agents out there that would love to take care of you.
Oh, that's great.
So Sam, one of the questions that comes up as a landlord, we were talking a little bit about tenants here. What is, I guess, the best way to kind of position ourselves with our tenants in terms of a renter's insurance policy?
Yeah, I think I would always recommend including that in the lease, that renter's insurance is needed for that tenant to rent your living space. And the reason, you're really going to be covered in two ways. The first way is you've got extra liability. So we talked about liability earlier. You've got two policies now that will respond in the case of a liability event. And the second one is that renter's personal property is not covered under your policy. So your policy will cover none of their stuff. And in the event of a loss, obviously, if they lose all of their personal property, maybe it's a family in the house and they brought all of their furniture, everything inside. They're going to ask you, hey, are you going to reimburse me for all of this, or what do we do? And to avoid that conversation, avoid any suit that could come from that, the renter's insurance policy is going to do it. And again, it is not expensive to have the renter's insurance policy. It's not like a full homeowner's policy or anything like that. So I would just, again, include it in the lease. It's not expensive. If they're not willing to do it, then maybe they're not the right tenant for your space anyway.
Great tip. Thank you.
Great. Sam, we really appreciate you being here today. I think kind of trying to back up into maybe one summary thought is you did a great job of describing a lot of different types of insurances that may affect some of our students. But if you were a new home real estate investor and you were trying to rationalize and figure out, hey, of the 10 different types that we talked about, what do I really need? What's nice to have, and what just doesn't apply? Any guiding thoughts for that?
Yeah, I think the three non-negotiables for me is going to be the property coverage, which is going to come no matter what. The liability, you need at least 500,000 and hopefully more with your umbrella. And the third one is the water backup. In concordance with that, look, I would just chat with your significant other or chat with yourself and just critically think, what would I want to make sure is covered no matter what? And then bring that to the agent. Bring the story, bring what you want to do with the property and where you want to be covered to the agent, and let them kind of be the expert for you and come alongside you as an advisor and make sure that that's covered no matter what, would be my recommendation.
So listeners, I hope you've taken some copious notes here, because I think this is all incredibly useful information to help you kind of in your journey to find the right insurance agent and policy. we have put together a guide for you in the download section for week 3. So Sam is going to help put that guide together, and we'll post it out there, and it'll be a useful kind of Q&A that you can ask yourself and kind of go through that checklist for when you're shopping for your own insurance policy, some of the things to think about, and some of the questions you need to ask your agents as well.
Guys, this has been an incredible session. Sam, if our listeners and students want to get a hold of you or follow you, what are some ways they could get in touch?
Yeah, you can reach me anytime at my cell phone, 618-772-8480, or my email is my first name, Sam, at aadins.com. I'd love to talk with you. As I mentioned earlier, my goal, what gets me up in the morning, what gets me excited and fired up for this stuff is helping new investors or even investors with bigger portfolios reach that next level. So if I can help you do that by way of getting you a policy, great. If I can do that by way of just giving you advice and things to think through with the agent you are going to work with, I'm more than happy to do that as well. So please don't be shy and reach out when you need me.
That's awesome. Sam, thank you so much. Damon, another great show. Stackers, keep stacking, and we look forward to seeing you guys soon. Take care.
Thanks, guys.